Welcome to the Mortgage Brothers Podcast. I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everybody. This is our first podcast, first official podcast, and I'm telling you, we're excited. Tom and I, we want to use this podcast to be answering questions that borrowers have, sellers, buyers, real estate agents, anybody who's willing to listen, and anyone who has questions. We want to use this podcast as a medium to get this all these questions in the mortgage business out to them, right, Tom?
That's right.
Okay.
And you've been a huge proponent of this. You've been listening to podcasts for quite a while, and I haven't had as much experience, but I think this technically is called like a visual podcast, right?
Yeah, it's a video podcast. People will be able to listen to this both on audio and video. So anyone who can't see us and is just listening to the audio version, again, that we're just going to do our best to be answering borrower questions, and we'll try to keep it as simple as possible and keep it real pointed.
I like it. You want to do introductions real quick?
That's right. Okay. Since this is our first podcast, I'll go ahead and introduce Tom. Tom is my older brother, and Tom has, we're both born and raised here in the Valley, and Tom's been in the real estate for about 20 years. He actually went to school at St. Thomas, the Apostle Grade School, back in the day. Tom went to Brophy. Tom also then went to a little boarding school out back east for high school, and finished there, and he went to college in Franciscan University of Steubenville, Ohio, and then came back, got married, and has been in the real estate business for about 20 years.
And here I am.
There he is.
All right. So introduction for Eddie. So Eddie is my younger brother. He's been doing the finance mortgage thing for almost 20 years.
Well, 16.
Okay. Working on that on 20 years.
Yeah.
But background on Eddie is he went to St. Thomas. You were how many years below me?
I think it was
4.
4. Yeah.
4 years below me. Finished up at St. Thomas, did a short stint of homeschooling up in the mountains, which was an unbelievable experience. We could probably have a dedicated podcast just to that. After homeschooling for a couple of years, you went off to the same boarding school that your older siblings had gone to, right outside of Worcester, Mass.
That's right.
And graduated from there in what year?
96.
And then went on to Franciscan University of Steubenville, in which a couple of his older siblings had been to. Graduated from there 2000.
And
2001. You weren't on the 5-year plan, right? You did it in 4 years.
3.5, actually.
3.5.
Actually went to ASU for a semester.
I forgot about that.
Got the semester at ASU.
That's right. That was before or after? That was first.
Yeah, first.
Okay. And then married his college sweetheart, which is another story for another podcast, and did real estate for a couple of years. Did some fixing and flipping, and then kind of immediately jumped into the mortgage business.
Yeah.
And here we are working together, the Mortgage Brothers.
That's right. Hey, and you gave me a much better introduction than I gave you. I feel like I kind of cheated you on the details.
No, I don't think so.
Okay.
All right. So what are we talking about on our first podcast?
Okay. So what do borrowers ask us all the time? And we made this huge list. One of the most common questions borrowers ask us is, how much do I qualify for?
What do I qualify for, Tom?
Yeah.
That's the call we get all the time.
I'm not sure how much I qualify for. And then there's all sorts of ways to do it. So what we want to do is just, those of you who are not watching the actual video portion of this, we're going to try to use very basic math. Okay. We're going to try to explain it in a couple different ways. And we're going to give you some good tips on how to qualify, or how much you can kind of estimate how much you can qualify for. So again, there's there's the easiest way. I say the easiest and most thorough way to find out how much you pre-qualify for is to actually ask your loan officer and have them take a full application for you, have them run your credit, and they'll actually determine exactly how much you can qualify for. Okay. Now
that sounds very corporate, by the way.
does it? Okay. So that's, people are like, well, what if I don't want to take an application? And that happens a lot, right? People are like, well, I don't really want to talk to you and give you all my information.
But you know what the reality is? The reason why you are calling the loan officer is because there's so many variables. There's so many factors that it's very difficult to do a very quick synopsis, but we're trying to do the very quick synopsis.
That's right. So if someone does not want to take the application, this is exactly what I do. I mean, I'm gonna frame the scenario very simple for everybody, and we give you a really easy way to kind of figure it out on basically a back of a napkin. Now, what I do is I take the gross monthly income of a borrower, and imagine that it's $4,000 a month. Okay. Now, in general, I'm going to take 50% of that. Okay. So someone says they may make $4,000 a month. I take 50% of that. That's $2,000. What that means is the bank does not want their total debt amount per month to be over $2,000. That's 50%. So we call that a 50% debt to income ratio. So that's like at a very max, we want to keep it at 50%. So I take their gross monthly income, I divide it by 2. So that gives us 2,000. Now, put that to the side. Now I ask the borrower, how much, if you add up your car payment, your credit cards, your student loans, anything that shows up on the credit report, add that up, what does that equal? Now, imagine it's just for easy math equals $500. Okay. So we know that the bank, you follow me? Okay. So we know that we know that the bank will basically let them borrow up to $2,000. So they have already $5,000 into the credit card, student loans, car payments. So there's $1,500 left. That's the mortgage that they can qualify for, a payment, the mortgage payment, up to $1,500 a month, potentially.
And does that include HOA, everything?
Yeah, that's a really rough number.
I mean, it would have to.
Yes, it's going to include.
It would have to include everything. So if you get that cheap condo that's got a $250 per month payment, it's going to severely impact what you can afford because you're allowed $1,500 left. That's it.
So for this borrower, their scenario, they would have a $1,500 max. That's just how much they could afford, $1,500. Now people will say, well, what does a $1,500 mortgage equal? Or what does a $1,500 mortgage payment equal? So here's the simple math. Now you don't have to do it in your head because you probably just need a calculator or do it on a napkin, but you take $1,500 and this is the number I want you to remember. You want to divide that by this number, $6.50. Now that goes today. That's for the market today. We're recording this here at the very end of February 2019. So this is where market rates are today. And
so if I take 1,500 divided by 6.5, I come up with 230. What does that mean?
So so that means that is basically the calculation of $6.50 per thousand that you borrow. Okay. So that 230 that you see, that's 230,000.
Okay.
So
okay.
230,000.
So let's
someone would qualify for in that scenario.
Okay. So let's just say for some reason you made a little less than 4,000 and your income was 3,500. Divided by 2. Okay, so it's 1,750 minus your 500. So let's say you could afford 1,250. 1,250 would be your max mortgage payment. So what's that mean? You take 1,250.
Good point. You divide that by 6.5. That would now equals 192. That's $192,000.
Okay, so that seems pretty simple.
Yes, and I know that some of you are wondering, well, I didn't follow that. That maybe that was complicated. Just rewind this. You'll actually you'll discover it's actually quite simple. Okay. So just, take your time, listen to it. But again, you're just dividing that number by $6.50.
And how did you come up with your $500 debt?
the $500 debt was the example. That's just I just came up with it for easy math.
Just easy. Okay.
That's the amount that if someone had that's the total of all of their debt that would show up on their credit report. So that's their car payment, car loans, student loans.
So in summary, you take their income, divide it in half.
Yes.
Remove $500 or so for debt, and whatever's left, you divide that by 6.5.
That's right.
If you just first time starting, you make $2,000, divide it by 2, you have $1,000. You take out $500 worth of liability loans, you have $500 left.
Yeah.
It's not a real likely scenario, but that's
right.
how you do it.
Yeah, that's right. And then, we get, if someone's in that scenario, we realize right away, they don't really qualify for anything. And so that's right.
Simple. I like it.
So I hope that everyone's enjoyed this podcast, and we're going to continue to be answering questions that you have. So please email Tom or I. My email, we'll just make sure the email. My email is eddie@azmortgagebrothers.com, and Tom's is
tom@azmortgagebrothers.com.
That's right. Nice and simple. Eddie and Tom. And just email us the questions you want us to answer on our next future podcast, and we'll be sure to answer them. And anyway, be sure to subscribe to this channel. Is what we're going to do. Is we're going to continue to produce this content and to like it.
And if they want to unsubscribe before they even subscribed, is there a special button for that?
There is. Yeah, there is an unsubscribe, and you're more than welcome to do that too. We won't take offense.
Okay. All right. Thanks. Good job, Ed.
All right. Peace out. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917, and 1618695, Equal Housing Lender.